big gains coming through, but a lot of the markets are seeing at least, a tinge of green right now.
Remember, this 7.08 comes over a 7% last year, same month.
20,350, that's the first level I'd like to put out. That
second investor at the $100 billion valuation. So that marks and gives more stamp of approval.
First take on the index, standing tall above that 20,000 mark, 90 points higher on the Nifty now.
Talk of bubble, and there's a lot of talk of all that. I don't think we are anywhere near bubble territory.
Along the way, there are going to be sharp pullbacks also.
There is a huge geopolitical context in which this is being located.
They've gone ahead and raised the buyback price to 3,200 from 3,000 rupees a share that they had earlier.
Markets where there has been a shakedown. The Nifty and the sensex are absolutely flat.
In the recent past, we have demonstrated a lot of progress in the area of alternative fuels.
After the initial downtick that we saw in the mid-cap index, the selling pressure sort of got arrested.
Well, that was the day so far. You're with us here on a fresh new edition of Closing Bell. We're coming to you live from the CNBC-TV18 Motilal studios. I'm Prashant. With me, my colleagues Reema and Surabhi. Nigel, of course, is also going to be here in just a bit. Guys, hi. Good afternoon. It's basically been a pretty sort of subdued kind of session from the morning. The whack came through early in the day with the mid-cap and small-cap spaces both correcting. And today actually is the first proper sell-off we've seen in that part of the market in a long, long time. So this is the mid-cap index on your screen, off the lows, but not very much. And the small-cap index perhaps a little worse off because gains there were spectacular. I mean, from the 31st of March, as of yesterday's close, the mid-cap index had gained, not 45, the small-cap index had gained 45%, and the mid-cap index had gained a little under 40% or so. This against the Nifty's gain in the same period of 15%. So, this is the part of the market which is galloping ahead, and there has been a bit of a knock. The Nifty is recovered. I mean, it's basically trading unchanged. Historically speaking, right, we've seen instances, and I went back and looked at this, we've seen instances where, the Nifty does quite a bit, large caps do quite a bit, and that kind of signals a bit of a top for the overall market. I couldn't really find any instances where the Nifty's not done very much. The mid and small caps rally hard, and then that signals a top for the market. So the conclusion being that it's possible that mid and small caps hang around here, don't do very much. It's too early, but it's possible that, with the 3-4% kind of cuts we've seen on those two indices, today is perhaps, I mean, I don't want to say the worst is behind because it's just been one day, but it's possible that with these 3-4% kind of cuts, confidence is shaken a little bit, the momentum is broken, and those two indices hang around here for a while. But the Nifty moves on, and I think that is the real possibility. I also looked at the number of Nifty stocks which are crossing their respective 20-day moving averages, and I looked at the data for the last 4 days. Every day, you have 3 or 4 names in the Nifty index which are crossing their respective 20-day moving averages, basically lending support to the argument that it's possible while the broader markets take a bit of a break, the large caps perhaps have some catching up to do here. So that's where we find ourselves at. I mean, there you go, 20,000 on the Nifty as we begin this edition of Closing Bell. Reema.
Hi, it's just a bit of a shakeout, right?
Yeah.
In the broader market, there is no capitulation right now, but a bit of a shakeout. We've been talking about the mid and the small cap index. There's also another index, the Nifty Micro Cap 250 index, which basically covers the top 250 stocks, which are outside of the Nifty 500 stocks. And that index has seen a fall of close to about 4.6% right now. It had also seen a stupendous 60% rally from the beginning of April, and that's the segment which has seen the biggest hit. Individual constituents there, like Jindal Saw, Bajaj Hindustan, HCC, these are these stocks are a part of that micro cap 250 stocks, and they're getting hit quite hard, a 10% fall on them. The PSU related stocks are also getting hurt. They're hurting. PSC index, CPSC index, both these indices are down close to about 4%. Railway stocks like RVNL, IRCON, BHENL, REC, PFC, these stocks are taking a big blow. What's holding up are the defensive names. So IT and pharma, both these indices are providing that support to the markets.
Hi guys, I guess it just seems like people have been paying a lot of attention to the commentary that you've heard on this channel over the last 24 hours, right? Because right from the word go, I mean, almost all market experts we've been speaking to have been pointing out to this caution in mid caps. And most of them are saying that the market is fine. It's just that mid caps are perhaps, getting into a bit of an overheated zone, and you're better off in large caps. The market seems to be positioned for a large cap rally. The only issue is this has become common consensus, and markets rarely move as per absolute consensus. And the absolute consensus is now move money from large caps, move money from mid caps, put it in large caps, and that's what's playing out. And for what it's worth, today you've got leadership in the form of big moves on IT. In fact, let's pull up some of the large cap IT names. Look at TCS. It's the leader on the Nifty right now, 2.5% up. Infosys, even some of the other names like Wipro have done well. Let's pull up the Nifty contribution chart, and that will tell us that a lot of the IT names, L&T, and even some banks like ICICI Bank, they are the ones that are doing the heavy lifting. So large caps are not the problem. There we go. So you have some pressure from the likes of RIL and HUL, but otherwise the Nifty is okay. In the area where the profit taking is apparent, and again, it's not really a surprise, right? As Rima pointed out, it has to be PSUs. That's what's gone up 100% to about 200% in the last 1 year. So I'll just highlight the names just for reference. Whether it is something like a MMTC or a RailTel, NBCC, BHEL is down about 8.5%. That's where the money is coming off the table very, very quickly and sharply. PSUs is one area. And then some of the other industrial and infrastructure plays. Generally, this rally has been about industrials and infrastructure. So let's say a stock like IRB Infra, which is down about 7-8% as well. GMR Airports is down about 6-6.5%. So that's where the money is coming off PSUs, industrials, and infrastructure stocks. That's where the bulk of the price action is on the downside. But we have a birthday boy, Nigel, in the house as well. Nigel, we thought you'll join us in the studios, but you've decided to give us a cold shoulder. Nonetheless, what do you make you were still going with green on your birthday? I think that's the mood of the market, despite the shakeout in the mid-caps today.
Well, that's right. Surbhi, and this morning it's good to get a call right? On the Nifty itself, I said that, the crucial support zone is at around 19,910, 19,920, and we bounced off those levels. So whatever it's worth, the data point did support in today's trading session. And there were cautious signs from the broader market. So I think this sort of a pullback is healthy, and it's par for the course. The headline index, though, it's indicating, at least going by the momentum, going by the data points that we have, it's still very much in an uptrend. The question is, how do you position yourself in the final hour of trade? To help us out with that, Mitesh is back with us. Hi, Mitesh. Well, it's been that sort of a session, right? A little bit of consolidation, a little bit of sideways movement. But the good point is, the intraday dip got bought into. Your view on the Nifty, and if you had a long position, where's your stop loss?
Good afternoon, Nigel. I think you're right. The intraday dip got bought into, and I think it's been yet, some kind of a sector-specific movement on the upside at least. The IT is clearly the sector which is supporting the index. The rest of them have stopped falling. The Bank Nifty is also recovered. But I think the Bank Nifty remains, kind of in an underperformance mode. So given the fact that it's not an outperforming zone, I think, I would suggest that people who are trading the Bank Nifty lighten up their position on the long side at least. And the Nifty is still okay. I think, to me, between the indices, Nifty, I think till it breaks this 19,850, 900 zone, I think the upside should be valid, and we should still look for a test of around 20,000 to 5,300 levels. But you can, possibly traders, as I said, who should exit the Bank Nifty and possibly get into IT stocks, which are showing good traction as well as breakouts individually. So I have a buy on Infosys, and we've had buys on TCS and HLTech earlier. Infosys is a buy with a stop just below levels of 1477 and a target of 1535, 1540 can be looked at. And one sell just to balance it out on the upside. Bharat Forge is breaking down on an intraday basis, so maybe it looks like some profit booking happening over there. So keep a tight stop at 1095, look for a target of around 1050, 1045.
Okay, so tilting towards IT. Mitesh, thank you very much for that. Let's get you a CNBC TV18 exclusive now. We learned from sources that Chola Investment may be looking to raise money via the QIP route. Sonia joins in with the details. Sonia.
Well, thanks a lot for that. As you rightly pointed out, sources to CNBC TV18 have indicated that there is a QIP coming by Chola Finance, and they will be looking to raise money over the next couple of days itself. Now, the company is likely to float a QIP of around 2,000 odd crores. The base price is seen at around 1140 rupees a share, and the expectation is that the demand will be very strong for this QIP. Remember, on the 1st of August, the board had cleared an enabling resolution to raise 4,000 crores through the QIP route in one or more tranches, and we understand that the company has, taken 3 investment bankers on board to go ahead with this QIP over the next couple of days itself. As I said, the demand for this QIP is expected to be very strong. I reached out to the management. They are yet to give me an official confirmation on this, but we do understand that the company is looking to raise money for growth. They have shortlisted 3, investment bankers as advisors for the same. And earlier, Chola Finance had raised 1,200 crores via the QIP route way back in FY20. After that, this is the first time that they are raising money through the QIP route, expected to come through in the next couple of days itself. We are awaiting commentary from the management. Back to you.
Okay, all right. Thanks very much, Sonia, for that. That's an important story, and we'll get you updates as we go along. Nandan Chakrabarti is now joining us. He's a head of strategy at DAM Capital, and Nandan really needs no introduction. He's been closely sort of tracking markets, commenting on macro markets. I think at least 20 years more. I've been reading what Nandan has been writing for 20 years now. Nandan, good to have you back on the program, on the channel. It's been a while, and I hope this is the first of many. And we get you at a pretty opportune time, because we'd like to ask you, how are things looking? We've got a bit of a pullback. Actually, it's not a bit of a pullback. Let's call it what it is. It is a significant pullback, right? I mean, in a day, 4% kind of pullbacks on indices, mid-cap and small caps. It's not small. But what from here, in your opinion, for that part of the market as you see it?
The strategy report that you just released about 8 days back answers 6 questions that everybody is asking. So let me give you a little bit of perspective on these 6 questions and what are our conclusions. After that, we can go into detail in any of them. So the first thing, if you look at the cover of the strategy report, basically it shows a tiger with his jaws open and a tiger bird, which is basically the Indian tree pie, which is trying to pick its teeth and get out morsels. This is a synergistic relationship. Both the animals have the same skin color, and this has been for thousands of millennia of years. This has been going on. The idea is that when the tiger's jaw is open, which means it's a bull market, it can close any time. So you have to be very selective in what you purchase. So that's the overall idea. See, second thing is whether the question that people are asking are we in a bubble already, or is it just a bull market? So first thing I'd like to say is essentially liquidity drives the phases of the markets. And when I was in INAM, I think I did a lot of strategy reports on the various phases of the market on a qualitative basis. So liquidity is not the same as earnings growth. Earnings growth, valuations, relative valuations, all 3 play a part in liquidity coming and going. And that's how the markets are made. So you can have very lukewarm earnings growth, but a low P, which then starts going up in expectation that results in a bull market. So there are 3 things which are important. So in terms of a bubble or a bull market now, what we've done in the strategy report is I've basically taken the last 20 years, the various bubbles, and said that, and basically compared the valuations and so on. So today you are among, or maybe the most expensive market in the world among all the major markets. There's no question about it. However, in terms of the premium to the US markets, and in terms of the premium to emerging markets, which is largely China and the others, and with respect to your own 5-year history, compared to the earlier bubbles, you are not in an alert zone. So that's the first thing. Number 2 is there is no great, in terms of the advanced decline line, 52 new 52-week highs, etc., etc. There's nothing which is alarming as of now. Usually there is a narrowing of the rally. So if you look day to day, most of the days, once in 3 days, the PSU bank sector goes up. Otherwise, it's almost every day a new sector is going up. So there is no narrowing of the rally as of now, which is the usual, test of a bubble forming. So the first is that we are not in a bubble, we are in a bull market. Second is now where do we go from here? So basically there are 4 indicators which I think we need to track. Number 1 is FII flows. So FII flows depends on two things. What happens in the US in terms of Fed rate and US recovery and all that. And second is China. The stimulus that they started talking about in January, and again they started talking about last month, whether there is any steam to it or not, and therefore will some monies outflow to China instead of India. It can happen, but very unlikely as of now. We've got serious problems. Third is there any slowdown in SIPs, which have been the backbone of the Indian domestic markets? Third, is the El Nino. So there is El Nino, there is SOI and so on. The basically different indicators have now come up from the Australian Met, whether there'll be an El Nino this month or not. Fourth is the results of the 4 major state elections out of the 5. So these are the 4 indicators I think that we must look for in terms of the markets. The third is where are the earnings alerts. So if you look at the results so far in terms of downgrades as well as the results themselves, there are 3 areas where the results have not been very good. Chemicals, IT, and capital goods. Capital goods, of course, the order books are crazy. So these formed about 15% of the total market weightage of NSE 200. Second is the El Nino. That's an alert. So it will affect a vast swath of different these things. It is a large percentage. It comes to 28% of the NSE 200, but obviously it will not affect all of them dramatically. So there's auto, cement, there's that, all the normal these things, NBFCs, etc. So that is the second part. The third question that people ask is what is happening to the mid-cap rally. So we released this report around about 8 days back. Essentially what we are saying is that mid-caps go up either when there's a GDP surprise, which is not the case now, or when the premium to the NSE 200 or the Nifty is it's at a huge discount. Today, the price to book, normal discount to the Nifty is minus 8%, you're already at 10% premium. So at 18% premium to what it should be. So mid caps are obviously, and the reason for this huge overvaluation of mid caps has been basically the way our markets are structured. So we have $270 billion of mutual fund money. We have $270 billion, which is the same amount in retail, which includes PMS, which has become a huge amount, which is $67 billion. So what happens is large funds, FIIs, insurance, etc., normally don't put money in small and mid caps. But the amount of retail and PMS has basically shot up. So that is the reason for this mid cap rally. Yeah.
Nandan, if you could allow me to come in over there, and that's exactly the question that I've been having, on my mind since morning, watching the mid cap correction. The collective wisdom that seems to be coming out right now is that the market is okay. Mid caps have rallied a lot. So as long as maybe you alter positions a bit, unload from mid caps, invest more in large caps, you'll be fine. Do you agree with this near consensus that seems to be emerging?
See, it's very difficult to get in and out of markets for a retail investor. Mid caps and small caps by itself are basically quite illiquid. You can't have a strategy of getting in and out wherever you think it's right. So mid caps may not correct, may just go on and do a time correction. What you have to be concerned about is which type of mid caps are you in? Are you in the price to order book mid caps, which are huge, which sectors we know, or you're not? If you look at a typical mutual fund which has mid cap portfolio, say, if you take the top 20, very few are in these frightening stocks. Also remember, a mid cap, when it gets overvalued, it's not that the earnings growth is bad. It is just that your expectations is far more. So just like in 2000 when you had Infosys earnings growth was not bad. It was just that the price expectations were far, far more. So similarly for mid caps, which are basically order book driven industries, these are revenues which are over a very long time. So it will be executed, whatever, a few percentage each year. And then
so would you agree?
Price.
So are you saying that what's happening right now is that we don't have a quality issue when it comes to mid caps, as we've seen in some past cycles, where just the quality of the kind of stocks that was going up was questionable. So we're not in that zone, but it's just that the market has run ahead of itself, way ahead, purely in terms of earnings expectations. Is that the problem? And can we safely say that?
The first one, yeah. So the first one, if you see the institutional portfolios of mid caps and you take the top 20 stocks that they own, there are very few stocks which are, dangerous stocks, which are overpriced stocks. The problem is in the individual investor, maybe PMS. So it really depends on stock to stock. The institutions are not in that much of a problem. As a matter of fact, many of the institutional funds have been quite hesitant to put in money. Inflows keep coming, so they have to put. But a lot of them were in cash in the last 1 month. So I think that is the issue. It is a type of stock that you are in mid caps.
Nandan, so coming in on that point, the type of stocks which have gone up in the last 6 months or in the last 1 year have been the aerospace, the defense, the capital goods, the industrial, the power, renewable. Those are the themes which are largely the PSU stocks which the street, the retail investors have latched on to, even by way of direct investments. What would be the advice on these group of stocks?
So do a sanity check on what you own. It's as simple as that, yeah.
But
None
in your assessment, do you
managers...
think... No, but you did speak about, in some cases, these are long gestation orders. There could be volatility in the order inflows for companies, say in the defense, etc., or even in railway, for instance. Do you think broadly this category has run ahead of itself?
Yeah. So the margins are not very high, so you don't have too much of a buffer. And these are fairly long gestation. So it will take a long time to unfold. So it is not that these stocks are, bad quality. It is just that the expectations are far more.
Hi Nandan, good afternoon. Nigel on this side. Good to have you on the show. And then, few stocks though, I'm going through a report, the DAM Capital India strategy, and some potential doublers is what you'll have identified. Run us through a few of them.
So, see, essentially, if we are saying that the mid-cap rally is sort of overdone and there could be a time correction and so on, so where does the safety lie? So the idea is to give those, few stocks, 11 stocks is what we've given, a cricket team or football team, whatever you call it, where the EBITDA can double in the next 3 years. So you have a doubling of the EBITDA, which is roughly about 25%, 26% CAGR, where the PE, there is little chance of PE derating, and where the target price upside is not negative. So if you get these, you get a clutch of stocks which are still, in the sanity this thing list.
So are the sanitary stocks in the sanity list, Nandan? You guessed my second question, right? Basically, let's talk real estate, let's talk home builders, home improvement. Sanitary is part of that. But is does sanitary have sanity?
So the stocks in the realty space are fairly valued. So they are not very high, neither are they too low. They are not really order book related stocks. The problem has come in the order book related stocks.
So price to order book is what you called it, Nandan, right? That is railways, defense, what else?
Yeah, all that.
Even so, these two
Space,
primarily.
Space research. There's so many of those. Capital goods. So, these what will happen is basically the danger areas now are basically two areas. One is rural and the other is capex outlook. So,
by the way,
sorry?
Yeah, sorry, go on, please finish.
Yeah, so as far as the rural scene is concerned, El Nino on the one hand is a Damocles sword over us. On the other hand, the government is going to spend a lot of money pre-election. And the other area is capex outlook, where the government is basically front-ended all its capex, and which is the hope is that will flow into the private sector. But the private sector basically has been very weak in the results, but the order books are very strong.
Yeah, no, absolutely. Got that. Nandan, we'll leave it there. Good chat today. Appreciate you joining in. And as I said, hope you come back sooner than this one. Thank you. Well, let's just take a quick look at what the market is doing. Not very much. 8 points lower. Broader market still under pressure with a 4% cut in the small cap index and the mid cap index, which is down 3% or so. We are back. Dinshaw Irani of Helios Capital India on the other side. Stay tuned.
Welcome back. Well, you're tuned in Closing Bell. You're on CNBC-TV18. Well, we've been discussing the markets, and to help us out with that, we have Dinshaw Irani, Chief Investment Officer at Helios Capital India, who joins us on the show. Hi, Dinshaw. Thanks so much for joining in. Well, the consensus seems to be leaning towards the large caps, and maybe some part of the mid-cap and small-cap indices, well, they are looking a little bit frothy. Do you believe so? Or do you still cite that maybe there are still plenty of opportunities? You'd rather go with the mid and the small caps?
Nigel, thank you for having me on your show, and a very good afternoon to you, your team, and the viewers. So, Nigel, basically, I think the excesses which are getting corrected now. I think the market was waiting for 20,000 for the narrower indices, the broader indices rather, to start collapsing per se. But we always felt that, actually, Nigel, that things were very frothy, especially in the mid-cap space, because mid-cap, unfortunately, are limited to 150 stocks, right? And the way the money was flowing in, there were only these 150 where anyone could have invested as such. So that space had become highly frothy. In the smallest cap space, unfortunately, the money was flowing to funds which are mostly concentrating only on the index-specific small caps, right? But however, the small cap, it's an ocean. Anything beyond 250 is a small cap. So you could have very well dug a bit deeper and got good values as such. I think that's where the value lies today, beyond the index. But obviously, the way the money was flowing into these the sector-specific stocks, rather in mutual funds, that's why you're seeing this kind of a frothiness in the index-specific stocks as such. So I would rather stay away from the mid caps. Small caps, still there's a lot of flavor left.
A lot of flavor left in the small cap universe. That's interesting. Do you want to elaborate a little bit more?
Yeah, as I said, the fact is that most of the small cap mutual funds, which have become really large now, 30, 40,000 crores in small cap mutual funds, particular schemes, obviously they don't have much choice. They're only investing in the small cap space, which is in the index, the stocks which are in the index. But if you go beyond that, you have enough and more to invest in. Like, for instance, we got a few small caps which are at 12, 13 Ps in our portfolio. Obviously, our analysts are doing much more, sweat work to find out these names for us as such. So there is comfort there. But as I said, that if you look at, obviously, index-based small caps, you're in for trouble. I think that story over there is overdone.
Okay, Dinshaw, hi, good afternoon. Interesting, at least you're still looking at that part of the market, because otherwise it's, people are just wondering what to do, what to sell, whether to stay on. So, okay, let's talk overall. If someone is looking at the rally and, suffering a bit of a FOMO and wondering whether this is the time to deploy, what would your advice be? I know wisdom is that never time the markets, but in general, because we also have a lot of events coming up, right? We have the inflation print. Today we'll get the CPI numbers for India, then we get the US inflation numbers. Go on and look at more macros. And then obviously over the next 6 months, we're running into elections. There's a lot that's going to happen. So how should you go about making fresh money allocations in this market now?
So here's how we look at it. By the way, let me just clarify. As I said, that small caps are anything beyond 250 stocks. The top 250 stocks are small caps, right? So there's enough. It's like an ocean. So you have enough ideas if you can work harder and take out those ideas. That's why I'm saying that the space beyond the index looks very good, right? Not within the index. So that's one clarity I want to bring in. Apart from that, the good thing that we take away from the market today is, despite crossing 20,000, which is an all-time high as such, the fact is that the valuations are still in sync with history. If you look at, and we've always been promoting the fact that you should look at only the valuations post demon, because after that only the real culture caught on, equity culture caught on. So if you look at that post demon, I think the valuations were something like 19.5 times 1 year forward. And today we are at 18.5 times. We're talking about the narrow index right now, which is Nifty 50, where it's around 18.5 times forward index. So I don't see that part to be frothy. I think there's enough options available in the large cap space where you can look at. And plus, obviously, when an investor comes to us, since we are a mix of, we don't like a flexi cap, our PMS and the AIF offering is a flexi cap kind of offering. We always say and tell them that, why don't you stagger your investment? look at it over 5 months, because by then you'll have all these problems that you stated out of the way for us. So it's better to stagger it across, as you rightly stated. You cannot time the market, but we are very comfortable with the fact that in the next 5 years you see a secular growth story in our country, and obviously in our minds we're looking at a mid-teens kind of CAGR for the next 5 years in the index per se. So you don't want to miss that out. So just stagger it across, average out, and play the market that.
Time for, Dinshaw, hi, afternoon. Time for HDFC Bank and the likes to start to get some interest?
I think so, Prashant. The fact is that these two guys, I mean, the banking sector per se has been a total laggard. If you see the rally which has happened especially in the large cap portfolios as such. So banks per se, I think, is on the way up. And if anything, HDFC Bank being the probably the biggest guy who hasn't performed much, I think it's a time for him to start rallying. Overhang, obviously, it did start moving up, but an overhang came by way of RBI imposing that additional 10% CRR on these guys. But I think that is now out of the way. You know the flight path for that as such, and I think that hurdle is out of the way. So looks like good. Growth should be a problem on the asset side. It's more of the liabilities that they have to manage, and I think they're doing a good job there.
Okay, Dinshaw, let me come back to the statement that you made because we're not finding too many people who are sticking their neck out for small caps and mid caps right now. So I'm going to come back to that. So, tell us some themes and ideas, because I remember our past conversations. I mean, you've been cautious on consumer. You've been looking at IT, also with a fair amount of sort of caution, but stocks have already run up. CapEx, I don't even know what to say. PSUs, I know you've never liked PSUs, you've not been holding PSUs. So what beyond the mid cap and small cap index per se?
Okay, now the mid cap, as I told you, it's 150 stocks, so avoid those. Okay, that's what we're looking at avoiding. In fact, we've been constantly probably, trimming our names in the mid caps. We also are comfortable with the kind of valuations that are there. In the smaller cap space, you have enough consumer names. You have stories like the auto space, auto ancillary space, where you can work around, where they're niche pairs, right? So as I told you that we have a particular stock which is a 13 PE, and obviously that's in the auto Hank space, and it's a purely an outsourcing story. He's got this massive market share in whichever segment that he's, and I won't name the segment because you'll be able to make out what I'm talking about. So that's how you dig around and you look at stocks there. Obviously, there are limited stories there, so you have to be very careful. But one thing that we're very clear about is that the growth has to support this kind of valuations per se. So if there is growth built in there, that is what we are looking at, and at obviously reasonable valuations. So we have probably growth players at reasonable value as such. So that's how I would put it.
Dinshaw, out of time. Thank you very much for joining in today. As we slip into a break, here is a quick programming note for all our viewers. Our special edition of Editors Roundtable is coming up at 3:30 p.m. today. We'll get you a sneak preview of what are the big themes that we're covering today. Well, the mid-cap index has fallen more than 1,000 points, close to a 3% fall after witnessing an unprecedented rally over the last few weeks. Anuj will take us through the valuation picture of the mid and the small cap space.
The government has created a lot of wealth post-IPOs of select companies, but what lies ahead for these stocks? Will the government offload some more stake? Nigel will get us a quick analysis.
And finally, the commentary from the best market voices on whether this correction is a one-off or is it time to exercise caution. So don't forget to tune in to CNBC-TV18 at 3:30 p.m. today. Welcome back. No signs of the pressure abating for the mid and the small cap universe. The mid cap index is down more than 1,200 points. Bajaj Hindustan 11% lower. Indiabulls Real Estate 10% down. IFCI, RVNL, or HCC, NBCC, REC, across the board, you are seeing a big fall. Nimesh is joining in, and it's the perfect time to tell you what dealing rooms are saying this afternoon. Nimesh.
Hi, Rima. So it's a kind of a wake-up call, so to speak, for in the broader markets. For the way that many of the stocks were running on a daily basis, 10%, 15%, I guess it's a bit of a reality check as well. The mid-cap index is down 3%, small cap is down even more, and there are sharp cuts across the broader markets. Now, there was a call in the last couple of days that maybe the focus will shift to the large caps, and that's clearly playing out. The mid-cap index is down, but the large cap index or the largest stocks are relatively outperforming, and within that, I think there is a clear buying interest towards the large IT names. So that's the overall feedback. Couple of reasons that I have understood talking to some dealers on the big fall in the broader markets. Two reasons, largely two reasons. One, there is a strong buzz or an indication that there is a change at a leading FI fund in terms of the fund management chain, and hence you're seeing a bit of a sell-off in the portfolio that particular fund was holding. So that's one specific reason been explained. And the second one is a large private bank has actually raised the margin limits across clients for the mid-cap and small-cap stocks. So that explains a bit of unwinding in the broader markets from the retail clients as well. So these are the two specific reasons I'm told is a key reason for a big fall in the broader markets, especially in the mid-cap and the small-cap. But broadly, the chatter seems to be, or the narration seems to be, that in the at least immediate near term, you could see a bit of shift from mid-cap and small-cap to the large-cap stocks.
Okay. Thanks very much, Nimesh, for that. What about individual stocks? What are you picking up?
Well, in terms of individual names, the first stock in my list is Zomato. Stock is under pressure today across. It's part of that broader market underperformance. But there is strong buying interest from larger institutions. In fact, there was a selling for the last couple of days. That seems to be largely over. And today, the indication is there is a strong buy flow from a couple of large funds into Zomato. Plus, there was a Bernstein upgrade as well. And they've raised the target price to 120 on Zomato now. So that's the first stock. The second stock is SBI. Within the PSU basket, while the stock is marginally under pressure, but there is across the board buying interest back in the PSU names, and SBI stands out. In fact, in SBI, the feedback is that maybe a large long-only fund is an active buyer in SBI in the last couple of days, and they've bought in today's dip as well. So that's SBI. The third stock is TCS. While I spoke about the overall IT doing good, TCS stands out largely on back of very strong buy flow. So the delivery volumes are going to be quite high in TCS in today's trade. And the last stock is Prestige Estate. That stock is under pressure today, down 5% last when I checked. The volumes are on the higher side, and looks like a long-only fund is an active seller for the last many days, and that's the reason why Prestige is specifically under pressure within the real estate basket in today's trade.
Okay, all right, Nimesh, thank you very much. Interesting list as always. Good getting that from you. Well, Mitesh is now with us to tell us what to buy or sell today for a reverse trade tomorrow. Mitesh, what do you have?
I would want to add, Prashant, two sell calls, purely because of the fact that we've been carrying long position. I presume clients would also be, or viewers would also be, and therefore adding something on the short side may not be a bad idea. I have a BT or STVT on a gas authority or GAIL. That's STVT with the stop at about levels of 124.5 and a target of around 118, 117 can be looked at. And the other one is Cummins India, which I would recommend taking a STVT position. Sorry, not Cummins, Crompton is the stock. Crompton is an STVT with a stop at 310 for targets of 300 to about 299.
Okay, thank you very much for that. A little bit of a pressure is now kicking in at the frontline index. Today is also the Fin Nifty weekly expiry, and the Nifty Bank is now inching towards a 100-point fall. But the big question now is, where are we headed from here? What have the market experts made of the fall, the setup in the market? Surbhi's now moved over to the big wall, and she's compiled all the intelligent voices that we've heard through the course of the last 48 hours. Surbhi.
Well, thank you very much for that. It's as divided as it gets. And I'm just rounding up views from both foreign investors, foreign brokers, as well as some of the local market veterans just put this caveat out that some views have come in after we hit the 20K mark and some in the last 2-3 days, basically in the run up to 20K. So the views are as relevant as ever. Let's start first with CLSA, probably one of the most bullish voices I've come across in the last 24 hours. It's a note from Vikas Jain, who goes on to say that India has the most compelling earnings growth story over the next 2 years in the 20 most well-tracked large markets. He's going on to say that the expectation is that India will see a corporate earnings growth of 17% over the next 2 years, beating the top 20 global markets, which is why CLSA feels that this market, the Indian market, is not that expensive and that valuations are still not overstretched. In fact, they're saying that, the current levels are a good entry point for the India market. So that's CLSA for you. Let's move to Jefferies. Now, the note from Jefferies comes in after their Hong Kong conference, which is where Greed and Fear says that they observed how emerging market investors are looking at markets like India and China. Now, they're saying that the stance is still an overweight on India and an underweight on China from a structural standpoint. However, tactically, they agree that investors may look at shifting out of India in favor of China just because the Chinese market hasn't done well and the Indian market has. Let's move to some of the more bearish, or should I say cautious voices. Sanjay Mukem of JP Morgan is definitely one of them, and he's citing risks that are coming in from the macros. High oil prices, the fact that monsoon has been deficit. These are the key macro concerns that he's citing, and he's saying that because of this, they would be advising a shift from the growth to the value side of the market and reducing beta basically in their India portfolio. That's JP Morgan for you. Let's come to perhaps the most cautious global voice that we've heard in the last 24 hours, and that's Rahul Chadha of Mirae Asset Global Investments. Now, Rahul goes on to say that mid-caps and small caps are almost looking worrisome because of the huge run-up that we've seen, especially against a global backdrop where the Fed is expected to tighten more. In fact, he's saying that the global narrative in the coming few weeks and months will change from the expectations that rates have peaked off to expectations that we need quick rate cuts because growth will start slowing down. Mirae is expecting the US market to undergo a correction as well. So that's a really cautious view coming in. Let's now come to the local voices, and some of these concerns on mid-caps are actually resonating in these local voices as well. I want to start first with Sunil Singhania. Sunil is saying that valuations are actually okay. They're comfortable. They're not out of whack. They're not unreasonable. If you go by FY25 forward earnings, where we are trading at 18 times, so that's not completely unreasonable. But he goes on to add that even he incrementally would look at putting more money in large caps rather than mid caps right now. Come to Nilesha, who's saying that we need to be cautious. Nilesh acknowledges that, yes, there's a tremendous flow of money coming in mid cap funds, but investors need to look at quality and need to look at their investment horizon. That's very, very important if you're coming in now and want to buy mid caps. Finally, Atul Suri, he's calling it out. He's saying this is not a bubble top at all. It is a bull market. However, even he says that this continuing rise in the US bond yields and the entire inflation narrative, that is a key risk for him as well. In fact, on that note, let's hear out some of these market experts.
I feel where the market is heading or what my targets were. I see that there is still more upside going ahead. As I said, there's a lot of panic, there's a lot of talk of bubble, and there's a lot of talk of all that. I don't think we are anywhere near bubble territory. I think that there is more upside. And what I say is that you've seen 11% and you're like getting this thing, that we can have another 8, 10, 9, 10%, And a lot of people say that, oh, you want to sell out this segment, we should get out, blah, blah, blah. You never know. You could be missing a more interesting part in the market.
I really believe that in the near term, there is now catching up to do from the large cap side. I think when you look at stocks which offer you value on fundamental basis, more large caps pop up than the micro caps and the small caps. I think there's a lot of fear of missing out, a lot of momentum, a lot of theme-based investing, particularly from the mass retail, which is happening on the smaller companies. And, I would, really believe that it is time now for the large caps to do some catching up. And, Nifty at like less than 18 times P clearly offers more value than some of the smaller companies.
It's not a destination. And you will see many thousands like this, 20,000, 25,000, 30,000. Only problem is with the speed where the market is rising. That could be a little worrisome and all. And I will tell you one example. Pratyaksham kim pramanam, as they say, that I have not sold any shares, and whatever shares if I have sold, I have put them into some I have bought some other shares. So I'm bullish in the market. It's a journey. It will keep on happening, and stocks will keep on rising and falling and churning, and all these things will happen in this market. These PSUs and all those railway stocks and defense stocks and all. Let me tell you, I personally find them now very expensive. Okay, beyond imagination, they are expensive. So people should understand, people should always remember. See, if your view is for 10 years, like Sunil ji said, India story, if you are really playing India story, that means you are playing for a decade. Then it is all right. But you are talking about India story and playing about T2T ka story or PTSD story or 6-month story or 3-month story, then you are in problem. Then you should remember, as I always say, that Rome was not built in a day, but Hiroshima and Nagasaki were destroyed in a day. So this is what people should be very cautious.
I think this move in mid-small caps up nearly 35 to 40% since last 6 months, when globally Fed is tightening, balance sheet is contracting, would be a bit worrisome. So again, that's something we've been doing since, I would say, last 2-3 months. Look at our mid-cap portfolio, some of these mid-cap names, whether it's hospitals, real estate, or other sectors. Look, we've owned them for 5-7 years, but look, valuations look kind of fairly full here. So what we're doing is top slicing probably 10-15% and moving that to large caps.
Get into a break on that note. We'll come back with more in the market. Stay tuned.
Okay, welcome back. We've got the market, which is down, 6 points. I mean, the Nifty is absolutely flat, but I have to say that the small cap index has picked up a little bit more on the downside. We're at the lowest point in the small cap index, and which is basically about 4.25% down at the low point of the day, absolutely. And look at the mid cap index as well, where there is, I think we're at the low point of the day there as well, on the mid cap index. Yeah, we are. Actually, we've not been spending too much time looking at the broader market and the stocks which are falling, because indices are down 3.5-4%. But maybe it does make sense to take a quick look, right? I mean, what's happening here across the board. Maybe if you can follow me on these stocks. RVNL, 12% lower, just very briefly, 10-12 names. Look at, that it'll come up on your screen. Look at BHEL down 10%, Mazgaon down 10%, Cochin Shipyard down 12%. There is Indiabulls Housing Finance down 10%. All 10, I mean double digit, right? Railtel down 10%. Reliance Power down 12%. GMDC down 10%. BEML down 11%. There is, and this is the, ranked by the largest price plus volume that we're seeing across the board. Infibeam down 10%. Garden Reach down 10%. Rights down 10%. NBCC down 10%. Nagarjuna Construction Company down 9%. There is Tube Investments, which is down 9.5%. Engineers India is down 9%. And so many more. I mean, it's a long list. I mean, I don't remember the last time I've seen this kind of a screen. Not in a very long time, really. So this is real, bit of a bloodbath going on in the broader markets in this segment. Well, let's bring in Jay Bala of cashthechaos.com. He's joining us now. Jay, good to have you with us here. Thanks for your time. Let's start with mid and small cap indices, and technically, what do these big bars on the downside, 3.5% and 4% respectively, mean from here for these indices?
Thanks for having me on the show, Prashant. I was here last week and it was very brief for just 2-3 minutes, and we had just a bit of time to say the mid cap and small caps are running into an exhaustion, and that's exactly what has happened for the mid and small cap indices. They might still have little more, or probably a final high to come through, but it's not something you want to play on. And that's the reason why I warned last week, and we're seeing that severity of the cut right now today. So I think even if there is the markets where the indices were to go up another 5% above the all-time high, it may not be worth playing that.
Okay. Jay, hi, good afternoon. So that's the story on mid caps and small caps. There is caution. What about the headline index? I mean, the narrative on the fundamental side still is that, maybe large caps still have more room to go on the upside. But what are the charts indicating? And also, when you look at the bigger global picture, specifically the US 10-year yield, how should we tie all this in?
Yeah, very important. I don't see much upside for the large cap indices, basically the Nifty. I see probably one final higher high to come through, but we'll take it as the market unravels, and we'll take one step at a time. And when it comes to the global indices, I've been extremely bullish on the US 10-year yields. I've spelled out from a long-term perspective, we are looking at least 700 basis points for the US 10-year yields. But what happens in the short term? We had an extreme short-term high for the US 10-year yields. This can play out two ways. Either the equity markets sell off and there is a flight to safety, and because of this, the US 10-year yields, they sharply fall. Or we could see further highs to come through if we see the US 10-year yields cross 4.85. So we're going to see a direct push past, push towards 500 bips for the US 10-year yields in the short term. So one of the two is going to play out when 4.85 is a zeta for me. And the US equities in particular,
is there, Jay, let me come in because, that's quite a sobering thought. I'm not talking about 700 basis points. Let's not talk about the US 10-year going to 7% just yet. That's like, that would be major capitulation. I don't know what event can trigger that. Let's leave that on, park that on the side for now. But you said 4.85% on the US 10-year. Is there a time range, any time indicators that you're working with by which this may happen?
Yeah, I'm working with this 4.85 from a 3 to 6 months perspective. This is dependent on on immediate term yields crossing 4.285. Right now it's at about 4.279. So if that were to cross, I think there's a more direct move towards 500 basis points. But, if we see a break below 4.2, probably there's going to be equity market sell-off and there's a flight to safety. And the 700 bits that I'm talking about is a 24-month price objective, not an immediate short-term price objective. So, it's going to, before it gets to 700, we're going to see probably a sharp dip towards 3.8 or 3.5. So, when it comes to the US markets, semiconductor indices are the most vulnerable, and that's where the last rally has happened. The AA rally has been triggered by the stock that's in the semiconductor sector. And that is the most vulnerable, and that can bring weakness to the technology sector.
Any pockets where, you know, there is relative safety right now that you would bet on, individual stocks, sectors, where fresh allocation can be made?
I wouldn't advocate fresh allocation. I would say you should hold on to it. But if you're a trader, you can be in capital goods space, and that's still quite strong. Probably further highs that I'm anticipating for the Nifty. That's going to be probably driven by the capital goods space. And IT probably it's got a extreme short-term upside left somewhere about 34,600 for the Nifty IT. So when it comes to individual name, I would even look at some in the Nifty Pharma Index. I've been saying that for the last few weeks, that Pharma Index has got further higher highs to come through. So I even have a small cap name here, Jackson Pharma. As long as the stocks can hold above 412, I think it's going for fresh all-time highs towards 540. But be careful, this is the last leg of the move for the particular stock.
Okay, last leg of the move. Many have been talking about, by the way, when you look at the Nifty mid-cap, you can look at it individually, right? I mean, technically how they're looking. Many also look at ratios, right? The small cap to Nifty, mid-cap to Nifty, and how that ratio has panned out over the last 10, 15 years. Do you look at that as well as a measure of, what's happening in these spaces? Is that useful if you've looked at it? Yeah.
Oh, it's definitely useful, but that's not the way I go about it. To me, everything is a derivative of price. So I look at the first, the direct picture rather than a derivative of it. But as one of the gentlemen has recently commented, it's the speed of the move and the verticalness of the mid cap and the small cap. That's the worrisome problem. If the participation has been so broad that it helps in the thrust of the market, but the speed at which it's gone in the last 6 months, that's a little euphoric. So, that's a reason for caution.
Okay, all right. We'll leave it there. Jay, thank you very much for your time. Appreciate you sort of being here on the program. Thanks indeed. Just if you can have the Nifty mid-cap and small-cap indices up on the screen at the same time, I think that will tell you the kind of day we've had, right? I don't think we've seen this kind of day in a long time. The Nifty will end, in the green, 1-2 point, whatever, but, in the green, the sensex will do. Look at the Nifty. But if you can have the mid and small caps as well, along with one of the larger indices, that'll tell you what happened. 4% in small caps down, 3% in the mid cap index down, and the Nifty and the sensex doing what they've done, which is actually ending slightly higher. So just quite an incredible session. And I did run you through this long list of, the big volume-led losers that we had in the mid and small cap part of the market. Advanced decline, on my screen, 2,000 stocks are down and about 350 stocks are higher. So that's the picture, not a pretty one. And the crossover happened very aggressively early in the day. There you go. I mean, right after market open, within the first 30, 35 minutes that started happening. And then it's basically been just like that through the course of the day, despite the slight pullbacks that we've had in the markets, guys.
Okay, let's run you through some of the big, winners on the Nifty. What held it afloat, close to levels of 20,000. IT all the way. So TCS was the top Nifty gainer. Stock at a fresh 52-week high, 2.7% up. Infosys gaining. L&T slipped a bit from the day's high, but still ending strong with a gain of about 2% after the buyback price got revised higher to 3,200. Pharma names, Dr. Reddy's, Divi supported, and then you had gainers in the form of ICICI Bank and ITC. On the losing side, many of these PSU, BPCL, NTPC slipped in trade. NTPC was down close to about 3.4%. Power name, Power Grid under pressure. Coal India weak. The Adani Group stocks, which rallied to a 7-month high in terms of capitalization, also weak in trade. And then you had that bit of a flip-flop on auto names, but finally all of them ending with cuts. M&M down 1.9%.
And now we come to the mid-cap story, and here it is simply a case of what goes up must come down. So your usual names, RVNL down about 10% today, BHEL down 10%, RailTel down 10, MMTC down 10, NBCC down 9. A lot of these central or even state PSUs, GMDC down 9%. These are the names: SJVN, REC, PFC. It's a long list of PSU stocks. Let me now come to the PSU banks. UCO Bank down 8%, Central Bank of India down 7%, You have more names, even on the private side, actually, even an RBL bank for that matter, losing some ground. Bank of Maharashtra down. So tier 2 financials, basically, J&K Bank, IDBI Bank, across both sides of the spectrum, private and PSU. Basically, banks were weak. Then you have names like IEX, IRB Infra, some of these momentum names from the power or the industrial space, infrastructure, power industrials. They have really led the rally, and today that was the area where we saw lots of cool-off. Adani Power, Power Grid, Tata Power. These were the names on the downside. Even some of the metal names like SAIL and Vedanta cooling off quite a bit. So that's been the story on the mid-cap side. But one stock, let's talk about one gainer at least. NIIT locked up in 20% upper circuit as the day winds up. That was an interesting one to note. But otherwise, of course, a day of lots of profit-taking on the mid-cap screen. So there we have it. We're getting a close just below the 20,000 handle, 19,984 on the Nifty. Mid-cap index down 3%. Remember, we'll come back with the inflation print and the IIP print, and let's see, we'll pick it up from there. But for today, it's been all about cooling off in the mid-cap market. It's a wrap on this edition of Closing Bell, but don't go anywhere because our special edition of the Editors Roundtable is coming up next right after this break.